Prior to the financial crisis in the late 2000s, the UK was an economic powerhouse. In 2007, the country's GDP per capita was over $50,000, an incredibly high figure, even when compared to other developed economies. However, by the end of 2021, 14 years later, this number has not increased. In fact, it's dropped by about $3,000. Meaning, from the start of the crisis to today, people in the UK are essentially poorer now than they were in 2007. By comparison, the world's average GDP per capita grew by over 40% during the same period, whereas the UK's fall in this measurement represents a decrease of about 6.5%. But why is this happening? And will this devastating economic trend continue for the UK? Well, the answer can be quite complex. In this video, we'll start off by discussing the negative factors affecting the country's economic future, and then the positive ones, evaluating the points along the way. With these points explained and analysed in detail, we will be able to form a constructive conclusion to what the future holds for the UK's economy, where we will look at several forecasts predicting the trajectory of the country's economy, both in the short term and in the long term. Starting off with perhaps one of the most widely known negative factors is the UK's ageing population. Many of you may already be aware of this, but an ageing population is incredibly devastating to an economy. In essence, this is when the proportion of older people becomes greater in a given population. Such a scenario is bad because it means a large portion of the population will not be working, as older people tend to retire and leave the workforce. Some of you may be wondering, why is this necessarily bad? Well, if there are less people working, the productive potential of the country decreases, lowering national income and GDP. But to what extent is this true for the UK? Estimates say that the country is said to increase its proportion of people over 65 years old from 19% in 2019 to 24% in 2043, which can be attributed to lower rates of fertility and a higher life expectancy. 24% may not seem like much, but an aging population does not only affect the productive potential of a country. It also means that pensions have to be paid to those who are retired, which can be costly. The UK has actually already thought of ways to combat this issue. One of the main solutions being to force people to have saved enough money once they retire, which is not exactly an ideal solution. But unfortunately, even though there seems to be somewhat of a solution, there are many more negatives that come with an aging population, such as increased inflation as older people tend to save less money, and more houses being occupied per capita as older people tend to live alone. Thus, the UK's aging population will inherently hinder its economic growth. Another large negative factor is the UK's ability to trade internationally. You see, for an economy to prosper, they have to be able to trade as freely as possible. An increase in the trade of goods and services traded is usually accompanied with an increase in GDP and national income. For the UK especially, trade is crucial. Estimates say half of the country's GDP derives from foreign trade. For comparison, the USA's ratio is only about a fifth. However, the UK's trade-dependent economy is losing its competitive edge, and this can be attributed to Brexit. Brexit has resulted in a massive increase in trade barriers and trade costs in goods and services, which has worsened trade relations with the EU. It is estimated that there has been a fall of 25% in UK imports from the EU relative to the rest of the world, which is estimated to have caused a 6% increase in food prices. There has also been a major fall in UK exports of services, also 6%, and around 10% of total assets of the UK's banking system have been relocated. Some say Brexit will make it easier to trade more freely with non-EU markets, such as the US and Australia, which may be true. However, for the foreseeable future, the UK is going to face a rise in trade barriers and trade costs, which is estimated to translate into a loss in real wages and labour productivity. Speaking of labour productivity, this is a major negative factor which the UK struggles with. According to some estimates, the country's labour productivity sits at just under $55 per hour, a low figure when compared to other successful economies. This is defined as how much GDP is produced on average per hour worked. Since 1983, the UK's growth rate in this measurement has fallen behind other Western economies. But why? Many say this is caused by chronic underinvestment in the public and business sectors. In fact, public investment dramatically decreased from 4.5% of GDP from 1949 to 1979 to around 1.5% after 1979. On top of all that, the share of the UK's GDP focused on business investment has been trending downwards since the early 1960s. The reason for this comes from structural reasons. You see, the prices for capital goods, which are in essence investments such as machinery, have decreased dramatically relative to other goods. Think food, entertainment, clothes, etc. This means that if a government wanted to, say, construct or fix a road, the price at which it would cost would be less today in comparison to other consumption goods than it would be many decades ago. So investments are now cheaper relative to other goods. The UK took advantage of this by spending less of its GDP in investments, lowering the labour productivity of the country. There are more factors causing the UK's low levels of labour productivity, such as income inequality, but the main point affecting the economic future of the country is said to entail the one that we just discussed: the fact that the government has not been spending enough on investing in its economy. But how will this affect the future of the country's economy? Truth be told, investments take time and money, and considering the economic situation of today, there isn't much room for any major investments to take place, meaning that the country's labour productivity is not expected to improve significantly in the foreseeable future, which hinders its economic future. Next up, let's talk about debt. The UK holds a generous amount of debt. In the latest report, the country is said to have a debt to GDP ratio of over 99%. In fact, many countries, especially Western ones, have been seeing dramatic rises in their debts throughout the last few decades. As for the UK, the debt to GDP ratio hasn't been this high since the 1950s, which even then was mostly due to the effects of World War II. But how will this high debt ratio impact the future of its economy? Well, for high levels of debt to be paid, governments usually have to set out strict austerity measures. This means lowering government spending and increasing taxes, which can severely hinder economic growth as it crowds out private sector investment and spending. Not only that, austerity measures also typically lead to more unemployment, lower wages, and higher rates of inequality. And even if the UK is able to pay off its debt, some estimates, such as by the Office for Budget Responsibility, say that due to the pressure of various negative factors affecting its economy, many of which we've already discussed, will inevitably cause the country's debt to grow exponentially. So to wrap up this point, the UK is struggling with a modest amount of debt, which is constraining its economic future. Talking about government policy, let's take a look at the UK's monetary policy, another negative factor. It's no secret that inflation in the country has risen to record levels, a staggering 11%, whilst a healthy inflation rate is said to be around 2%. If inflation becomes too high in a country, governments are typically forced to raise interest rates to control rising prices, which is precisely what is being done in the UK. Since December of 2021 to the 3rd of November of this year, the Bank of England has made interest rates rise from 0.1% to 3%, and this is only expected to increase. According to some analysts, this could rise to 4.75% by 2023. This means individuals and businesses are facing higher borrowing costs, which can have a profound effect on an economy. Businesses may halt their expansionary plans and investments will decline. Therefore, to sum up this point, higher interest rates typically mean economic growth is usually slowed, which is the current case for the UK. Lastly, perhaps one of the most negative relevant factors that affects the UK's economy: geopolitics. With the current war in Ukraine, many are just now speculating the extent to which geopolitics can impact a country's economy in unprecedented speeds. It's reported that in 2021, prior to the war, Russia was the UK's largest supplier of refined oil, at over 24% of all imports of this commodity, as well as 5.9% and 4.9% of the country's crude oil and gas imports respectively. However, due to the war, currently imports from Russia are essentially at zero. Evidently, this has caused dramatic increases in inflation of energy prices, which not only affects households but also businesses, especially those who are reliant on energy, massively hindering economic growth. So in essence, geopolitical events such as wars can cause massive shocks to economies such as the UK, especially those who are reliant on certain imports such as oil and gas. Expanding on geopolitical risks, if international tensions continue to elevate, a further fragmentation of the world economy could occur. Geopolitical blocs could be formed, each setting their own technological standards, cross-border payments, and reserve currencies. These potential events can hinder global economic growth as global trade and international cooperation plummets, which could affect the UK to a considerable extent. Now, having discussed all these negative factors, may have given you a very doomed picture of not only the economic future of the UK, but the country as a whole. In fact, perhaps most countries around the globe. However, there are several positive factors which could push the UK to economic prosperity. Let's talk about them. Most importantly, the UK is still a large and powerful economy as of today. Currently, the country's GDP sits at $3.19 trillion, ranking 5th in the entire world. The country's GDP per capita of around $47,000 is still a relatively high figure compared to global standards, ranking 22nd in the world, ahead of France, Japan, and Italy. So, although there may be various negative factors affecting the country's economy, it still boasts one of the wealthiest and powerful economies in the world. Moving on to another positive factor is the fact that the UK has one of the most skilled workforces in the entire world. According to a study, nearly 46% of people aged 25 to 64 have completed some form of tertiary education in the UK. In fact, the country ranks 5th in the world in this regard. The UK is also home to 4 out of the top 10 universities in the world, with the country's educational system being considered one of the best in the world. On top of it all, the country has a set of flexible labour laws, which make it easier for businesses to hire staff in a way that suits their needs. According to the World Economic Forum, UK businesses get more flexibility in determining wages than any other nation in Western Europe, as well as every country in the G7 except Japan. Labour costs are said to be highly competitive in the UK. In fact, it's reported that the country has one of the most, if not the most competitive labour costs in Western Europe, meaning businesses can operate with lower costs than in other Western countries. Even so, the UK has one of the lowest unemployment rates in Europe at just 3.6%. For comparison, the average unemployment rate for countries in the Euro area is said to be 6.6%. So to sum up this section, the fact that it's easy for businesses to employ skilled labour at relatively low costs compared to other Western nations creates a strong pillar for the UK's economy. One more positive factor is the fact that the UK has one of the strongest financial sectors in the world, in particular due to its international reach. It's said that the country holds the most globally connected banking hub, as well as it being the largest centre for international debt issuance, commercial insurance, as well as reinsurance, and lastly foreign exchange trading. According to a recent report, the UK's forex trading amounted to 38% of total global trading, making it the country hosting the largest trades in foreign exchange. An absurd number compared to the second biggest forex trading hub, the USA, at just 19%. Moreover, another contributor to the UK's financial hub is London's bullion market, which is the world's largest market for gold and silver trading. But what exactly is the future for the financial sector in the UK? Well, even though the financial institutions don't have high hopes for the coming year, due to the economic environment we're currently in, they do see a bright side in being able to reduce their operating expenses with technological improvements and being able to recruit highly skilled staff. This presents a more hopeful trajectory in the financial sector compared to the rest of the sectors of the country's economy. So to sum up this point, the country's financial sector is a powerful backbone to the economy. And although there isn't much hope for growth in this sector in the coming year, they are still doing relatively better than most sectors of the UK. Lastly, another positive point in regards to the UK's economic future is the fact that it boasts a well-diversified economy. It thrives mostly in the services sector, accounting for 75% of its GDP, which includes several industries such as finance and business services, as well as consumer-focused industries, retail, food and beverage, and entertainment. Manufacturing and production are said to account for about 20% of its GDP, with cars the biggest portion produced in this sector. Simply, the country has many industries across its sectors, which have contributed to it having the 10th most diverse economy in 2020, according to the Economic Complexity Index. However, there have been calls for the economy to be even further diversified. These discussions do hold a large amount of validity, as in actuality, the UK was the 4th most diversified economy in the year 2000, 6 places higher than it is according to the most recent report. Nevertheless, the UK's economy is still quite diversified, and therefore contributes a bit of stability in an economy that seems to be lacking it, especially nowadays. So far, we have discussed the positive and negative factors influencing the economic future of the United Kingdom. But what can we expect? Nowadays, all we hear is that the UK is headed for economic disaster. But what do the forecasts say? First, let's look at some short-term forecasts. One forecast, according to a press release by Ernst & Young in October of this year, says that we can expect a decrease of 0.3% in the UK's GDP next year, which is actually a downgrade of what was expected some months ago, which was a growth of 1%. However, the report predicts that from the second half of 2023, economic growth will resume, with an estimated growth of 2.4% in 2024 and 2.3% in 2025. This is due to an easing of high inflation, reducing the pressure on real incomes, tax cuts taking effect, a cheap pound causing exports to increase, and a reduction in high interest rates. Another forecast, this time by the Office for Budget Responsibility, predicts that the economy will drop by 1.4% in 2023. Quite the difference from the previous estimate for growth of 1.8% in their estimate in March of this year. However, once again, this forecast also predicts that economic growth will resume in 2024 and 2025, with a growth of 1.3% and 2.6% respectively. So, according to some short-term forecasts, economic growth is deemed to resume after the coming year, which sparks some hope. But what about the long-term trajectory of the UK's economy? Well, one press release by PricewaterhouseCoopers in 2016 suggested that the UK could be the fastest growing G7 economy until 2050, with an average annual growth of 1.9%, outpacing economies such as Germany, France, and Italy. By comparison, it predicted that the world economy would grow at an average annual rate of 2.5% until that year. Moreover, despite Brexit, they estimate that the UK will remain 10th in global economy rankings, with a GDP of about $5.4 trillion in terms of purchasing power parity. The press release also took note of many issues that the UK would struggle with, many of which we've already discussed, including an aging population, urge to improve infrastructure and trade. Of course, this report may not hold as much validity, as it could not take into account the unprecedented shock that came with the pandemic, as well as the war in Ukraine, since it was published in 2016. Looking at another long-term forecast updated in 2021, this time by the UK government, suggests that the country will remain roughly in the same economic position in the world by 2050 in economic size, which at the time of the forecast was 6th place. The forecast also noted that the UK's share of global GDP would fall from 3.3% to 2.7% by 2050, which can be attributed to the growth of emerging markets. Lastly, it was also reported that the country would benefit from new trade opportunities. This is due to exporters being able to capitalize on the growth of a global middle class, which means there will be more demand for more valuable goods and services which the UK tends to offer. So, to summarize these forecasts, it seems like the United Kingdom's economy is said to be on a healthy trajectory in the long term. However, the validity of these forecasts may have somewhat depleted as recent events have changed the outlook of many analysts. It is difficult to predict for certain what will happen to the country's economy due to such unprecedented events. However, it did seem like the UK was on a healthy path in remaining economically prosperous. So, to conclude this video, there are many factors affecting the UK's economic future, including positive ones and negative ones. For the short term, considering there is no dramatic change, most forecasts predict that after the second half of 2023, economic growth will resume for the country up until at least 2025. As for the long term, we simply cannot say for certain. Although economic growth seemed to be on the table, recent events have made this argument lose its validity. There are simply too many variables at stake, and therefore all we can do is wait and see. Having this video concluded, we want to appreciate you for sticking this long in the first episode of The Economic View. If you have something to add, or perhaps you disagree with something we said, please don't hesitate to comment. We're interested in hearing what you have to say, and hopefully we'll see you in the next episode.